Mexico, the 13th largest country globally and the second largest economy in Latin America, has long been overshadowed by its northern neighbor, the United States. However, its close proximity to the U.S. is now turning into a significant advantage, propelling its economic growth. The two countries share a 1,054-mile-long border, 54 border crossings, and 4 time zones, fostering a robust trade relationship that benefits both, especially Mexico. This trade relationship has led to a concentration of economic activity in Mexico's northern states, which boast a higher GDP per capita than the southern regions. These northern states have established a strong export base, less reliant on commodities. However, recent data shows significant growth in southern states like Oaxaca and Tabasco, driven by a phenomenon known as nearshoring. This practice involves relocating business operations to nearby countries, and it's gaining traction as American, European, and Asian companies move their operations to Mexico. This shift is largely due to increasing global tensions, particularly between the U.S. and China, making manufacturing in China less attractive. Foreign investment in Mexico reached record levels in 2023, with an 18% year-on-year growth. By February 2024, Mexico had surpassed China as the leading source of U.S. imports, fueling further economic growth. This has positioned Mexico as one of the fastest-growing economies in the G20, with wage growth at a record pace. However, significant challenges remain. Despite economic improvements, income inequality is high, with 1 in 3 people living in poverty. High levels of crime and a large informal sector further hinder Mexico's progress. Historically, Mexico's economy relied heavily on resource extraction, particularly oil. The discovery of large oil fields in the early 20th century, such as the Cerro Azul field, made Mexico a leading oil producer. Pemex, the state-owned oil company, has been a significant source of government revenue. However, over-reliance on oil led to economic instability, particularly during the 1982 debt crisis, when falling oil prices caused a public deficit and a decade of stagnation. In recent decades, Mexico has diversified its economy, joining the North American Free Trade Agreement, NAFTA, in 1994, which was later replaced by the USMCA, boosted trade and foreign direct investment, FDI. This led to the growth of the manufacturing sector, particularly in electronics and auto parts, and created new jobs. The nearshoring trend is expected to further boost Mexico's manufacturing industry, attracting investment from Europe and China as well. However, Mexico's productivity remains a challenge. From 1980 to 2019, its real GDP per capita growth averaged just 0.7%, significantly lower than similar countries. This stagnation is due to low productivity gains and a large informal sector, which accounts for 24% of GDP and 55% of employment. Workers in this sector lack benefits and face limited growth opportunities, which also hampers government tax collection. Educational attainment in Mexico is also low compared to other OECD countries. Improving education could address structural challenges, enhance productivity, and increase earnings. Additionally, the financial sector needs reform. Low levels of credit to firms and households limit economic growth and innovation. Despite these challenges, Mexico has significant potential to become a developed nation. Its proximity to the U.S. is a major advantage, particularly as nearshoring trends continue. A young and growing workforce also positions Mexico well for future growth. However, the country must effectively use incoming investment to build long-term economic capacity and reduce inequality. If managed well, Mexico's growth could continue to rise, transforming it into a more prosperous and developed nation.